Hello, everybody. My name is Grant Joyner. I am the founder of Vineyard Wealth Group. I'm a certified financial planner professional, and I'm an enrolled agent. And today I'm super excited to talk to you about retirement income planning. I think this is one of the most important topics that I talk about with my clients and prospects and just generally out there. You spend a lifetime saving money, accumulating. You're used to that number going upwards, getting a paycheck. And for a lot of people, believe it or not, it is hard to go the other direction. When you're used to the money just going straight up, it can be very difficult psychologically and otherwise to have it come down. So it's important to put together a retirement income plan that can work around that behavioral bias, but just also around all of the nuance with retirement income planning and creating your own paycheck. So let's jump into it. This is the complete retirement income planning guide. It's really how we see retirement income planning. And again, this will be a high-level overview of kind of the landscape, and in future videos, we're going to dive deeper into each one of these individual concepts. So we hope that you'll watch this one and those as well. So let's jump into the agenda today. We're going to talk about retirement income planning, the withdrawal strategy, Social Security claiming, retirement spending, and then required minimum distributions, where you're obligated to take money out of an account to generate some taxable activity. And turning savings into income, right? So how do we look at this? Anytime you have a big pot of money and you need to put together a retirement income plan, you're trying to factor in what your withdrawal strategy is, what your Social Security is, what the healthcare and inflation costs might be, what required minimum distributions might be. And you're trying to basically coalesce all of these items into an optimized strategy. And what you're doing is you're trying to coordinate this from not only an investment purpose, but you're also trying to coordinate it with your other guaranteed sources of income, Social Security, pension, taxes. And historically, there's been this 4% rule. So this 4% rule was created long ago, where it basically said if you had a 60-40 portfolio, 60% stocks or equities, 40% bonds, you could safely withdraw 4% of that for 30 years. And that number could increase with inflation over time, and you would never deplete your portfolio. Now, that's been called into question many times. Morningstar just came out with a study that says really 3.9% here. But one of the things with the 4% rule is that it's very rigid in how much you take out. And if you have any flexibility whatsoever, you can typically take out more, up to 4, 5, 6, maybe 7 or 8%, depending on your circumstances. And then ultimately, how much you need, right? So the simplest terms of how much do you need from your portfolio in retirement, how much money do you need to retire, is how much money is coming in from Social Security and pensions, and then how much money do you need to spend? What's the difference between those? That's how much you need from your portfolio. And then that's when you can start to back into what the portfolio size is that makes sense for your picture. Let's use an example. Let's say you get $50,000 from Social Security and pensions and you want to spend $100,000. The gap there's 50. If you take that number, multiply it by 20 to 25, that's again 4 or 5% rule. It's going to help you understand the size of the portfolio that you may need. Now, it's overly simplified rule because it's not factoring in taxes and tax structure and a lot of these other items, but it is a really nice baseline to start with. And we'll talk about how we use that baseline, how we build off of it, and how we go from there. So it's not just about your withdrawal rate. It's also about basically where you withdraw and how you adjust over time, right? Because in an ideal world, when you're heading into retirement, you'll have some assets that are after tax taxable accounts, whether they're investments or bank accounts. You'll have some tax-deferred assets like 401ks and IRAs, which have yet to be taxed. And then you'd have some tax-free assets, which are Roth IRAs, which grow completely tax-free. And during your retirement income period, going back to that example, let's say you needed $50,000 from your portfolio. Each year, it might make sense to take it from different places, depending on your tax situation for that individual year. Maybe you sold a stock or you sold a property and you have higher capital gains in a year. That would be a year where you lean on your taxable account or your Roth IRA. And in normal circumstances, maybe you're pulling it from your tax-deferred account. So it's not just about how much to withdraw, but it's where to withdraw it from, how to adjust over time with a sort of two hands on the wheel approach to make sure that you are maximizing your portfolio with asset structuring and you're minimizing your taxes, not only early in retirement, but throughout your entire retirement period, and then into estate planning, where Massachusetts has a very low estate tax threshold. Okay. So what we're going to talk about now is some of the risks, right? So there is a risk in retirement. When you're in accumulation, there's not really what's called a sequence of returns risk. It doesn't really matter what the market does year over year, because if you're not pulling money out of your portfolio, at the end, it will be the same. The percentages are just the same. And here's just a visualization of this. This is looking at the years 2008 to 2017, the S&P 500. And if you had $1 million invested and you weren't pulling any money out, the left side goes in order, 2008 to 2017 in order. And you can see you start off, you have a really bad year early, you get down to 630,000. And then by the end, you're up to 2.259 million because you have a bunch of good years after. But if you flip those returns in order, you start out stronger, but you end off really poorly. In 2009, you got 3.6, but then you end up in the same spot. So again, with no withdrawals, there's no sequence of return risk. No matter what, your portfolio will end up in the same place because it's just the percentage times the portfolio. However, if you are withdrawing money from your portfolio, this is where things start to change, right? Where if you're pulling money out, in this case, let's say we're using that $50,000 example, on the left side, you're going to see that starting negative early and then forcing yourself to sell something at a lower dollar amount means that your recovery is not quite the same versus the right side where if you start stronger. So this is one of the things that when we talk about retirement risk planning, you got 1.2 versus 1.6, is that when you're putting together a retirement income plan, those early years actually end up being some of the riskiest years if you especially have a lot of equities in your portfolio. And so what you're trying to do is mitigate against that sequence of return risk. And how do you do that? Well, you typically put together a portfolio structure that allows for your long-term assets to remain long-term. And then you have a bridge to get over that. If you knew you needed a $50,000 withdrawal from your portfolio, and typically a market downturn is going to last 2 or 3 or even 4 years, what you do is you build a bond bridge to get over it, or a bond tent sometimes as it's called. And that would allow you to not have to sell equities at a loss in order to fund your retirement income planning. And that, again, would help you avoid having a situation like this, where early in retirement, you have a bad year, and then your portfolio gets sold off when it's lower, and then it's a hard time recovering. So sequence of returns risk is a real risk. Social Security, obviously, is something that most people spend a whole career paying into. Everybody wants to maximize it. One of the main questions I get is Social Security running out of money? Obviously, there's a lot of fear that that's happening on. And there is some truth to the fact that for a very long time, especially with the boomer generation, that the trust fund was accumulating assets. And now with those folks retiring, it's dwindling assets. But Social Security running out of money doesn't mean that Social Security wouldn't exist, because you can see on the left here that's forecasted through 2033 that they can pay 100% of benefits. And then in 2034, they would, if they don't make any changes to it, that they would pay 83% of benefits in perpetuity until, well, not in perpetuity, but until the year 2100, where they could pay 65% of benefits. It's likely that some changes are made, that they're either bringing more money in or paying less benefits out or doing some combination of these. There's a lot of different levers that they can pull, and we'll get into that in another presentation. But the idea is that Social Security is not completely going away. It might change, but for most of the time, if they're making a change to Social Security administratively, they do it for the next generation, not this one. Not super politically favorable to make changes to Social Security for the people that are already receiving it. On the right side, most people have seen this chart. You can take it as early as 62, get a reduction. 67 is their full retirement age for most folks, and then you can wait up until age 70. And what makes sense for each individual is very specific to their retirement plan, their tax situation. And then if you have another spouse that's in there, oftentimes that makes it far more complicated, but a lot of times what you want is 2 disparate benefits, because you have spousal benefits while you're alive and survivor benefits after you pass. And if you have those survivor benefits, one of the biggest risks is if you're getting 2 payments, especially if they're equal, and you drop down to 1, that can be a big hit to retirement income planning. So this is something that when you look at retirement income planning, how important Social Security is for most folks, you want to get it right, and you want to make sure you get it right, not just for you, but for your spouse. And we're looking at health and longevity, your other retirement income, your need for income today, and then your spouse and survivor benefits. Required minimum distributions, or RMDs for simple. This is when you have a 401k or a tax-deferred IRA, and you haven't paid tax on the income in it, or you basically got a deduction when the money comes in, and the IRS will let you do that for so long, but eventually they're going to say, we want to generate taxable activity out of that. So they're going to force you to do it. It used to be that these would start at the age 70 and a half for everybody. And that's changed. It's sort of moved up. Now it's either 73 or 75, depending on when you were born. And it is calculated using life expectancy tables. And the IRS publishes these, and it's based off of the year-end value of your account times the life expectancy table. That's how much you're required to take out. The big piece of this is that if you have large tax deferred assets and you wait on required minimum distributions, if you don't do any planning ahead of time, it can create big spikes in your taxable income, which ideally you would avoid. Imagine you retired at 62 and then you waited until age 73 to take required minimum distributions. You might go from a 10 or 12% tax bracket up to 24 or 32% just based on those required minimum distributions alone. So it's something that you want to plan ahead of. You can utilize Roth conversions, just simply getting money out of your 401k at a lower dollar amount. There's even qualified charitable distributions, which you can send money directly to a charity without recognizing some of the income. But it's a big piece of optimizing retirement income planning, especially around taxes and asset structuring. You might have the 3 account types that we talked about previously: taxable, tax deferred, and tax free, but you want to make sure that you have the right investments and the right investment plan in each one of those accounts. So RMDs are required, but you want to have a strategy around them. And then ultimately, as it pertains to just spending over the course of retirement, there's a concept of a retirement spending smile, which is early in retirement, you're spending a lot of money, and a lot of that ends up being in leisure and travel and family. And then during the middle part of retirement, spending dips. And then at the later part of retirement, spending comes back up to where it was before, but a lot of that ends up being medical, long-term care, and those items alike. And that goes back to the safe withdrawal strategy. Oftentimes people might come in and they say, we need $50,000 from our portfolio to live. And that $50,000 is true early and late, but in the middle, it might be 30 or 40. So those safe withdrawal rates, you can't really just say 4% or 3.9 or even 5, because you're not factoring in pragmatically how spending really looks throughout retirement. And this is consistent with what I've seen when I've done thousands of retirement plans for people and help them put together their income plan. But every situation is different, right? And when it comes to retirement income planning, it's just as much art as it is science. And there's a lot of different levers where if you pull this is going to pop up. So you want to be very conscious of all of these things. If you do not have a retirement income plan or a retirement plan period, information's on the screen. You can call, you can go to our website, book a complimentary consultation. We're happy to put together a free retirement income plan. We have our Instagram on here where we put together a lot of content as well. Like I said, this is a sort of overarching view of this. We're going to be diving into all of these concepts in greater detail in the future. And we appreciate you watching along with this. We hope that you like this video, subscribe to our channel, share it with a friend that might be relevant. And we hope to see you again soon as we dive deeper into each one of these concepts, including doing case studies where we try to bring these to life even further with real life client scenarios. Thanks for watching.